There is a point in your financial life where you are pulled in two completely opposite directions. You want the security of being debt-free, but you also want the exponential wealth that comes from investing. Consider this scenario: a 25-year-old professional bringing in a combined household income of 45,000 rupees a month. Resting on their shoulders is a newly acquired 19.5 lakh rupee home loan, locked in at an interest rate of 9.15%. After cleaning up their monthly budget and pausing redundant savings plans, this earner has a monthly surplus of exactly 16,000 rupees. This chart maps out two options. On the left, funneling 16,000 rupees directly into the loan to wipe out debt fast. On the right, paying the minimum and putting the surplus straight into the market to let it compound. The math often says stock market returns outpace a 9% loan, but the math doesn't account for the daily psychological weight of carrying that debt. Choosing a path here doesn't just change your bank balance, it determines your net worth and your anxiety levels for the next 10 years. Before we can choose either path, we have to secure that 16,000 rupee surplus. That means plugging the financial leaks that are draining the monthly budget right now. The first leak is opaque insurance saving schemes. These plans often trap your capital for 5 years while offering poor liquidity and low returns. You have to stop these policies entirely. Ending the payments here instantly frees up 5,000 rupees of monthly capital. The second leak is informal debt borrowed from relatives. Even if it's interest-free, it creates constant social pressure and awkwardness. To clear this, take your annual workplace bonus, usually around 1 to 1.5 lakh rupees, and pay off the relatives in one move. This flowchart shows how those steps come together. By using the annual bonus to cone a family debt and canceling the bad insurance policies, you are left with a clean 16,000 rupees of surplus every single month. Pausing an early investment might feel counterproductive, but clearing these specific hurdles is a mandatory prerequisite. You cannot execute a decade-long wealth strategy if your foundation is unstable. Let's look at Path 1. This is the conservative strategy. You attack the principal loan to get the bank off your back. Looking at this comparison matrix, the first row outlines Path 1. We take 6,500 rupees of our surplus and add it directly to the monthly home loan payment. The remaining 9,000 rupees goes into safe debt mutual funds to build a liquid emergency buffer. By injecting that extra cash into the principal, a 12-year loan timeline is cut down to roughly 6 years. Over a 12-year window, spending the first 6 years destroying the debt and the next 6 saving, your final liquid corpus sits at roughly 37 lakh rupees. There is also a potential tailwind here. If you qualify for government housing subsidies, those funds hit your loan principal directly, speeding up this timeline even more. The victory of Path 1 is psychological. By age 32, you fully own your home, and you owe absolutely nothing to the bank. The trade-off is growth. By attacking the debt first, you sacrifice 6 years of compounding in the stock market. Path 1 is a defensive move. You are trading maximum financial growth for psychological peace and early ownership. Now let's break down Path 2. This is the aggressive strategy. You maintain your debt baseline to put every available rupee into the market. The second row of our matrix shows Path 2. We keep the home loan at its minimum payment and split the full 16,000 rupees into high-growth equity funds, Nifty 50, Flexi Cap, and Small Cap. To accelerate this, you increase your investment contributions by 5% every year as your salary grows. This strategy relies on the spread. You are paying 9% interest to the bank, while aiming to earn an average of 15% from the equity market over the long term. Because you never stop the compounding process, the math works in your favor. At the end of 12 years, you build a liquid portfolio of 55 lakh rupees. But consider the toll. You have to live for over 4,000 days knowing you still owe a massive amount of money to the bank. This path requires iron discipline. You will eventually have a 30 lakh rupee portfolio sitting in an app on your phone, and you must resist the urge to spend it on a car or a lifestyle upgrade. Path 2 is the offensive choice. It yields the highest possible net worth, but requires the stomach for the constant stress of debt. This scorecard boils the trade-off down to a single number. When we subtract the 37 lakh result from the 55 lakh result, we see the literal cost of the trade-off, 18 lakh rupees. That 18 lakh rupees is the objective price tag you pay to peace of mind over a 12-year window. If you have job instability or family members relying solely on your income, psychological safety is paramount. That points you to Path 1. For this profile, leaving 18 lakhs on the table is a worthwhile insurance premium to guarantee a secure home. On the other hand, if you're a young earner with a stable job, low-interest debt is a tool. This points to path 2. For the optimizer, giving up 18 lakhs in wealth just to satisfy an emotional fear of a loan is an unacceptable waste of leverage. You have to look at your own life and identify which psychological profile you actually fit into, rather than blindly following generic advice. Neither path is wrong. The choice simply depends on your risk tolerance. Pick your strategy, automate the payments, and don't look back. Hit subscribe and click the bell icon for our next breakdown.